Remember the days of near-zero interest rates, when borrowing was cheap and the stock market only seemed to go up? Those days are over. We've entered a new economic era, one defined by three powerful words: higher for longer. Welcome to the Economy Unpacked daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we re-unpacking one of the most significant economic shifts of our time, the era of persistently high interest rates. This isn't just a temporary measure to fight inflation. It's a fundamental reshaping of the global economy. Central banks around the world, from the U.S. Federal Reserve to the Bank of England, are signaling that the elevated rates we see today may be the new normal for years to come. But why is this happening? The primary driver is sticky inflation. Despite aggressive rate hikes, price pressures remain stubbornly high. This is fueled by tight labor markets, where strong wage growth keeps consumer demand robust and pushes costs up for businesses. At the same time, a quiet revolution is happening in global supply chains. Companies are moving production away from distant low-cost countries and closer to home, a process known as reshoring. This shift increases security and reliability, but also raises production costs, dismantling the decades-long trend of deflationary pressure from globalization. This video isn't about a short-term blip. It's about a long-term transformation that will affect your mortgage, your job, and your investments for the next decade. This higher-for-longer environment is not an accident. It's the result of powerful structural forces that have been building for years, creating a new global monetary landscape. The post-COVID inflation cycles were the initial trigger. Unprecedented government stimulus, pent-up consumer demand, and severe supply chain shocks created a perfect storm for persistent price increases. On top of this, geopolitical disruptions have thrown fuel on the fire. The energy crisis, sparked by war in Europe, coupled with ongoing trade tensions, has fundamentally increased the long-term cost of producing goods and services. Demographics are also playing a crucial role. Aging populations in many Western nations mean a shrinking labor force, which naturally leads to higher wages and, consequently, sustained inflation. Finally, the grand trend of deglobalization is reversing a 40-year economic paradigm. As economies pivot from cheap overseas manufacturing to more expensive domestic or regional production, the deflationary benefits we once took for granted are disappearing. These deep-seated shifts confirm that higher for longer is not just a policy choice, but a reflection of a fundamentally new economic reality. This new reality is hitting households hard across the developed world, from the United States and Canada to the UK and Australia. The most immediate and painful impact is on mortgage rates. The dramatic surge in borrowing costs has pushed homeownership out of reach for millions, creating a stark affordability crisis. A deep chasm is opening between older generations who locked in low rates and younger generations who now face the daunting prospect of never owning a home. But it's not just mortgages. High credit card APRs are turning everyday debt into a heavy burden, making it harder for families to manage their finances as interest charges accumulate. In response, households are tightening their belts. We're seeing a significant reduction in consumer spending on non-essentials like travel, dining, and entertainment. This widespread cutback is not only changing family budgets, but also reshaping entire industries that depend on discretionary spending, connecting macroeconomic policy directly to the struggles of everyday life. It's not just families feeling the squeeze. Businesses are facing immense pressure as well. The era of cheap money is over, and the cost of capital has skyrocketed. This means loans for expansion, upgrading equipment, or even hiring new staff have become significantly more expensive, forcing many companies to scale back their growth plans. Small businesses, the backbone of many economies, are particularly at risk. Many operate on thin profit margins and rely on variable rate loans, making them highly vulnerable to rising interest rates. Meanwhile, large corporations are staring down a refinancing cliff, trillions of dollars in cheap debt issued during the Lorette era will soon mature, and companies will be forced to refinance at today's much higher rates, a move that could cripple their profitability. This environment is creating a clear divide between winners and losers. Cash-rich corporations can weather the storm and even acquire struggling competitors, while highly leveraged companies face a fight for survival with many at risk of collapse. High rates are not just slowing the economy, they are actively reshaping the corporate landscape. The banking sector, which sits at the heart of the financial system, is also experiencing a turbulent adjustment. Initially, banks appeared to benefit from higher rates. As the gap between what they earn on loans and what they pay on deposits, their net interest margin widened. However, this advantage is proving temporary. As savers become more sophisticated, they are demanding higher returns on their deposits, moving their money to high-yield savings accounts or money market funds. This deposit pressure is squeezing bank profit margins. More ominously, rising rates create huge unrealized losses on banks' bond portfolios. As we saw with the U.S. regional bank failures in 2023, banks holding long-term bonds purchased when rates were low are now sitting on massive paper losses. This creates significant liquidity risks, especially for mid-sized banks, as nervous customers might withdraw funds in search of better returns or perceived safety, potentially triggering a modern-day bank run. One of the biggest paradoxes of this high-rate environment is in the housing market. Logic suggests that as mortgage rates soar and demand plummets, prices should crash. Yet, in many major markets, prices remain stubbornly high. The reason is a massive structural supply shortage. For years, new construction has failed to keep pace with population growth, creating a chronic lack of available homes. This problem is compounded by the locked-in effect. Millions of homeowners who secured ultra-low mortgage rates of 2 to 3% are now unwilling to sell and move, as doing so would mean taking on a new mortgage at 7% or higher. This refusal to sell has choked off the supply of existing homes, propping up prices even as fewer people can afford to buy. As a result, more people are forced into the rental market, driving up structural rent inflation. This dynamic is creating severe regional imbalances, with major metropolitan areas facing the most extreme affordability crises. The pressure of higher for longer extends all the way to national governments, straining public finances in an unprecedented way. With massive national debts accumulated over decades, the rising cost of servicing that debt is becoming a fiscal crisis. Governments in countries like the U.S. are now paying hundreds of billions of dollars more each year in interest payments alone. This creates a crowding out effect, where money that could have been invested in critical public services like schools, healthcare, or infrastructure is instead diverted to pay interest to bondholders. This fiscal strain also increases the risk of credit downgrades. As a nation's borrowing costs rise and its debt-to-GDP ratio worsens, credit rating agencies may lower its rating, making it even more expensive to borrow in the future. It's a vicious cycle, showing that entire nations, not just individual households and businesses, are grappling with the immense financial pressure of this new era. While developed nations are feeling the strain, emerging markets are being hit even harder, caught in the crossfire of global monetary tightening. A key reason is the persistently strong U.S. dollar, as the Federal Reserve keeps rates high. Investors flock to the safety and yield of the dollar, causing the currencies of developing countries to fall. A weaker currency makes it more expensive for these nations to import essential goods like food and energy, fueling inflation and hurting their citizens. Furthermore, many emerging markets and their corporations borrow in U.S. dollars. When their own currency weakens, the real cost of repaying that dollar-denominated debt skyrockets. This, combined with higher global borrowing costs, has pushed many developing nations toward a debt crisis, making it incredibly difficult to refinance their existing loans. The final blow is capital outflow. Investors are pulling money out of riskier emerging markets and moving it into safer, higher-yielding U.S. assets, draining these economies of the capital needed for growth and stability. For investors, the higher-for-longer regime has completely rewritten the playbook. The strategies that worked for the past decade are now failing. High-growth technology stocks, whose valuations were propped up by the promise of distant future profits, are under intense pressure. Higher interest rates mean those future cash flows are worth significantly less today, leading to sharp valuation resets. This has triggered a major sector rotation. Investors are shifting away from speculative growth stocks and moving toward value sectors like energy, industrials, and financials, which tend to perform better in an inflationary environment. After a decade of being dismissed as a poor investment, bonds are making a major comeback. With yields at their highest levels in years, bonds are once again an attractive option for generating income and providing portfolio stability. The real estate investment landscape is also shifting. While residential and office properties are struggling, industrial and logistics REITs, which own warehouses and distribution centers, are outperforming, driven by the ongoing growth of e-commerce and supply chain restructuring. Although the transition to a higher-for-longer world is painful, it may have some long-term silver linings. This new era forces a much-needed rebalancing of the global economy. The end of cheap money is instilling a more disciplined investment culture, discouraging the wild speculation and bubble-like behavior that characterized the last decade. Instead of chasing fleeting gains, capital is being allocated more thoughtfully toward companies with strong fundamentals and real profitability. This could pave the way for more stable, sustainable long-term growth as economies adjust away from debt-fueled consumption and toward genuine productivity gains. To combat high labor costs and persistent worker shortages, companies are now more motivated than ever to invest in automation and artificial intelligence. This technological adoption could unlock significant productivity improvements, helping to offset inflationary pressures and reshape the future of work. While the journey is challenging, these balancing forces are shaping the foundation for a more resilient and productive economy in the decade to come. This new economic chapter is still being written, and its effects will continue to unfold. We'll be tracking all the twists and turns right here. Thank you for watching this episode of Economy Unpacked Daily. Subscribe and hit the notification bell to stay informed as we continue to break down the complex forces shaping your financial world.